Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing Equinor stock. We'll be using fundamental analysis via TIKR terminal to go through the financials, and then I'll be sticking the numbers into my DCF and we'll come to a fair value of their stock. Let's get straight into it. Who are Equinor? So Equinor, formerly known as Statoil, is a Norwegian state-owned multinational energy company and it's headquartered in Stavanger. It's primarily a petroleum company operating in 36 countries, and it's got additional investments in renewable energy as well. So the company itself it's the Norwegian state-owned oil business basically. The government of Norway is the largest shareholder with 67% of the shares and the rest is public stock. So essentially what the Norwegian government says goes. But what's interesting is the Norwegian government have a real vested interest in this because this is how they pay for a lot of their sovereign wealth fund, how they get a lot of their income. Norway have got this $1 trillion sovereign wealth fund that's been funded by oil for decades now. Yeah, the company itself, it's interesting because they're listed in Oslo, which you'd expect, but they also have a listing on the New York Stock Exchange as well, so it makes it very accessible to invest in their shares. Now let's have a look at the sales per business for Equinor, and we'll start with 2021. And so, yeah, marketing, midstream and processing makes up 96%. The rest of it is pretty irrelevant. Renewables makes up like 2%, exploration 1%. So the mainly midstream business, yeah, there's not much to say on that front. Sales per region, so 74% of the sales come from Norway, makes sense, Norwegian. United States makes up 17%, and then 4% Denmark. You can go through the rest yourself, lots of other countries listed, but mostly Norway and a little bit of United States. Now let's take a look at the TIKR terminal financials for Equinor, and we'll start with the income statement as always, from 2017 to 2021. So revenues have increased over the past 5 years, but as you can see, with it being an oil company, the sales totally depend on the oil price. So yeah, 2020 oil went very low, we know. 2021 and now 2022 oil is really high, so you can see 2021 and from going on, if oil stays high, their sales are going to be high as well. It's just bonkers how much the oil price does affect these companies. So 2020, the sales are going to be half what they are going to be in 2022. Absolutely bonkers when you think about it. But these companies are investable if you know what you're doing, and if you buy at the right time in the cycle and stuff. There's a reason I do like these guys though. Net income wise, apart from 2020, they've made a profit, and that's quite rare for oil companies. Some oil companies need a certain oil price to be, to break even. Equinor is quite low. I think when I was reading last time, their break-even price was $30. That might be higher now with oil going up, but I think it might be 2021, their break-even price was $30 per barrel. Now we're at like $100 per barrel. These guys are just a cash-generating machine. Absolutely love it. Shares outstanding, pretty much flat. They've bought a few back, then issued some, and then bought some back, so let's just say they're flat, not very meaningful, probably to do with employee stock options. So employees get shares, as part of working for the business. Quite a common thing. Cash up over the past 5 years, expected 2021. That's not a surprise. Long-term debt, relatively flat. It looks like with the nice oil price. I'm a poet, I didn't even know it. With increase of debt a little bit, 2020 makes sense, then they've decreased a little bit, now oil's going good and they've probably got a lot of cash they need to get rid of. So manageable it looks like, not too much of an issue. Return earnings as well going up, love it. Cash flow statement, cash from operations minus capex is free cash flow. And then you can just see here, we'll have a look at 2020. So they were free cash flow positive even in 2020, which is awesome. But then look at this. Look at that. That is absolutely bonkers. Their free cash flow has like tripled since 2020 because of the oil price. But even before 2020, pretty consistent, free cash flow positive all the way through, which is just awesome. Dividends paid, increasing in dividends paid over time. A little bit? Nah, I'll take that back. Inconsistent dividends. Looks like 2018 they paid a decent one, then 2020, then they cut it, then 2021 they didn't. A little bit all over the shop. You want to keep your CVs consistent and rising over time. Repaying debts, they are paying dividends, which is decent, but you want this dividend to be staying the same and going up over time, not as inconsistent, if that makes sense. Then onto the ratios. Return on capital, solid when oil's good. So you can see 2020, anomaly year, but when oil's high, Equinor's looking good. It is looking good when oil's high, let's just say that. And you can just see the margins as well. When oil's at a high price, looks insane. And solid margins as well at the minute. Current ratio, even in bad times, it's solid. So it's one thing I like about this business compared to some other oil companies. The debt is a lot more manageable than others. So it's something I do love about this business. But yeah, if you're enjoying me going through TIKR Terminal, then hit the description down below. There's a link, sign up to TIKR, have a look yourself, and enjoy analysing stocks, because this platform is absolutely class and I'm loving using it, to be honest. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's have a look at the genuine impact stats for Equinor, and we'll start with the quality metrics. So it's looking very high, it's looking really good actually. Profitability high, capital allocation sound, very sound, financial strength medium. So it's looking like one of the highest quality stocks on the platform. I say if it's in the top 1,000, it is one of the best on the platform. You can see the gold shields across all of them. It's looking decent. Value wise, it's looking cheap, like based on certain metrics, so cash flow and income statement is looking cheap. Balance sheet cheap as well. Loving it. So growth wise, it's looking like a high growth stock, to be honest, and that's because oil's absolutely booming. And to take that with a pinch of salt, but interesting analysis there from genuine impact. Now let's have a look at my analysis checklist and DCF for Equinor, and market cap of 108 billion. Yep, 108 billion. Current price of $33 per share rounded, and PE ratio of 9. Cheap value stock, yeah? We will see, won't we? The return on capital 5-year average, 19%. Awesome stuff. The past 1 year, has probably helped it a lot, but we take it, don't we? But yeah, gross profits there. Net margin 5 years isn't quite there though. Let's have a quick look, see what it actually is at the minute. Net margins. Yeah, it looks like 2020 has brought this figure down a bit, because if you took that one out, I'm sure. Yeah, what would it be? Can't do it off the top of my head, but it won't meet the 10% that we look for. But even then, apart from 2020, they've made profit. We can take that a bit of an anomaly, but free cash flow was consistent without. So free cash flow is more important than profit, in my opinion, and it absolutely smashes it out of the park. Debt wise, it's looking decent, so the debt's manageable. Current ratio above 1, which we absolutely love. The CCC is below 60 as well, which is a really good added bonus. It means we get cash in the business very quick, which is very important. Proven ability to grow, all green, we know why. Oil high, it's showing the growth high on here, so take it with a pinch of salt, because oil prices being massively higher. It's looking good. It's looking like a tech company. Capital allocation wise, so long-term debt repayment, issued a tad bit of debt. Good acquisitions, looks like they've done some write-offs, so I want to look at what they are, because we don't want them writing stuff off all the time, because it's not good. Decreasing shares by a little bit and growing the dividend. Quality score of 80, so 80%, only 3 in the red. We take it, we take that. By a fair price, currently it's looking absolutely mega cheap. PE ratio of 9, price to free cash flow of 5. Yeah, it's looking like a value player, but let's have a look. with oil companies, it's all about the oil price. If oil's at a certain level, that's going to impact our financials. So let's have a look at my DCF. My DCF is showing that 2022 is going to, look pretty decent, but then it's going to simmer back down. We'll see if this is the case, but I think this is a conservative assumption that free cash flow comes down to a more normal level. We can't expect these good years forever, and you've got to take it with a pinch of salt. But with these free cash flow estimates from marketstrader.com, I think I put 2024 in myself because we didn't have 2024 up, so I just popped in a similar figure to 2023. So just assume no growth. Fair value of the company adjusted for cash, we're looking at $31 per share. Current share price is 32, so what's it saying? It's going to fall 4% for a 10% return. So it's not looking too bad. This all depends on where you think oil's going, let's be totally honest. If we think oil's going to be higher for longer due to all the geopolitical things going on, yeah, it's looking decent. Simple as that. But if we think oil's going back down to pre-2020 levels, then probably not a good thing to look at. Commodity businesses have this issue that is all dependent on the commodity price. I have my opinions on commodities, I'm sure other people do as well, but it's just interesting to see what the numbers do show in certain scenarios. I think for a company like Equinor, what it would be good to do is to have a scenario where oil stays where it is right now, maybe a bit of a worse scenario where oil falls to, $60 a barrel, and then maybe have one where it's at $30 per barrel. And you have three different scenarios and you weigh up the risk and reward with all of them, because I'm sure if oil goes to $30 a barrel, the fair value of Equinor probably goes down to like $10 or something, so that's to bear in mind. It's all to think about. So it all depends where you think oil's going, but it's looking like a good quality oil company, so very interesting if you're wanting to look into getting into oil stocks. So there we have it, that was my full stock analysis for Equinor. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching, I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one, however you can check out some of these videos.